This is lesson 1.3, still sticking with the double entry principles and the rules thereon. So, first one that we've come across is debit meaning in, credit meaning out. Yeah. So you debit the receiver, or value coming into an account, you credit the giver, the value going out of an account. Now, there's another one as well to remember always as well too, is that you are the business. Always remember that you're doing the accounts of the business. So if we put that as rule number 1, we put this one as rule number 2. Now, there's a third one coming into play now, which is going to be of great assistance to you, primarily when you're going to be doing final accounts. And that is, all debit balances are either assets or expenses. All credit balances are either liabilities or gains. Okay, so the first two we have already covered. So this is a third one now that's going to be of great value. So first of all, we have to know, what is balance? A balance is the difference between both sides of an account. So in other words, it basically means that the entries in assets and expenses are always going to be debited unless you're making them smaller or correcting them. And then the balances in liabilities and gains account, the entries in those accounts are going to be credited. It's going to be, it gives you a 50% chance of being right all the time. If you can identify what you're talking about being an asset, an expense, a liability, or a gain, you're sort of home and hosed. All right, so let's just take what each of these things are so that we're clear what an asset is. An asset is something of value that you own. Yes, everybody knows that. So it's something that you own, so we'll call that A, but it's also money that's owed to you. So it's two things. It's something that you own, but it's also money that's owed to you. Now, the assets in a company will be, buildings, vehicles, equipment, stock, but it'll also be debtors because these are people who owe you money. Yeah. Now, your assets, if we were doing this privately, would be your iPhone, or it would be a sound system, or any other things that you have in your possession, like, an expensive bicycle or a scooter or whatever. Yeah. So that's an asset. And those assets are debited. Remember that. You're going to debit assets. You're also going to debit your expenses. Why? Because expenses, these are services that you use. It's a service. Like in business, there are wages. And we take it from your point of view. Your call credit, that would be a service. Or going to the cinema, that would be a service that you would use. And the logic behind this is, to get any of those, you had to pay money. So if you want to get your phone, you had to pay money, to get your phone. Or if you had to get your call credit or whatever it is, you had to pay money to get your call credit, And that's why assets and expenses are debited, because to get these, you have to pay money. But all you have to do is remember that assets and expenses are debited. Great little rule to have. The next one, liabilities. A liability, usually it's money, well, it's nearly always money that you owe. Creditors, a loan, and believe it or not, capital also is a liability because the business owes that back to the owner. So a liability, and these liabilities are going to be credit. You don't come across a huge number of liabilities, but obviously there have to be, the total of liabilities and gains have to equal the total of assets and expenses, because that's the whole concept of double entry. So liabilities are credited. Also, gains are credited. Now, the gains you come across are mainly like anything received, but the main gain of any business is sales anyway. So rent received, discount received, any profits that you make, they're credited. So the rule then is all debit balances, are assets or expenses. All credit balances are liabilities or gains. Great little rule to have. that you will need going forward. Okay, can I just ask you to have a look at these questions and see how you get on? Are these accounts normally debited or credited? Purchase account is always debited. Why? Because the goods are coming in. Sales account is always credited, the goods are going out. Purchases returns are always credited because the goods are going out. These are goods that I bought, I'm now returning them. Sales returns are coming back into me, and that's why they're debited in. Capital account is always credited because the owner is giving. Drawings account is always debited because the owner is receiving. Wages account is always debited because it's an expense or the money's going into it. The buildings account is always debited because it's an asset, and to buy it you had to credit bank and it'll be debit building. The creditors account, by its very nature, is going to be credited from creditors because they're a liability, and a discount received account is going to be credited. Why? Because it's a gain. So you use any one of these three principles that we've studied to answer those questions. Okay, our next lesson is going to be on debtors, and we find everything we want to know about these people. See you then.
If you like this video, you'll love our notes. You can get some for free in the link in the description of this video.